is a program that will provide general information only on how to prepare a loan package which is directed towards business owners who wish to grow or expand their business and to individuals who want to start a business. So let's begin. We will cover 3 key objectives. 1. Describe how to prepare a loan package for a lender. 2. Explain how a lender will evaluate your loan request. 3. Provide access to resources that can assist you in preparing a loan package. Next is the topic outline. 1. Candid facts about borrowing money. 2. What a lender will need to know about your loan request. 3. The components of a typical loan package. And 4. How your loan request will be received. First, let's start with full disclosure. There are several issues that needs to be addressed up front. 1. There is no such thing as 100% financing. 2. Your credit history is important. 3. A lender will probably ask for a personal guarantee. And 4. There is no such thing as a government grant for individual small businesses. And lastly, number 5, SBA does not lend money directly to small businesses for any purpose other than disaster assistance. So you think you need a loan. Getting a business loan is an age-old problem, and many entrepreneurs find it to be one of the most greatest struggles that they face. So 1, be informed means doing your homework and understanding the borrowing process. 2, be prepared means putting together a meaningful loan package that addresses the most common questions a lender will ask. Questions such as, what is the specific purpose of the loan? How much of the loan are you requesting? When and how long will you need the funds? How will the loan be repaid? What collateral can be used to secure the loan? And last, will you provide a personal guarantee? The next topic is a major one. When a business owner is seeking to borrow money, they must provide a loan purpose. A lender will review your financial requirements based primarily on 2 types of capital infusion: working capital and growth capital. Working capital is used to meet fluctuating needs that will be repaid during the company's next full operating cycle, generally 1 year. Growth capital is used to meet needs that will be repaid with profits over a select period of time, usually not more than 7 years. Let's talk about loan amount. How much of a loan do you need to support specific business needs? This is a question you should address, not how much can I borrow. 2. Clearly defined business needs should be tightly aligned with the amount of financing you are requesting. And 3. Never ask to borrow money you don't need. Remember, 100% financing is not an option. Let's look at loan maturity and terms. A lender will want to know how long you need the borrowed funds. For instance, working capital loans or lines of credit would have a short-term maturity, typically under 1 year. Now, for an asset-based or equipment loan, perhaps to purchase a business vehicle or machinery, could have a maturity tied to the life cycle of the asset. This type of loan typically would have a maturity of 3 to 7 years. Let's visit the repayment of the loan. You should give serious and careful consideration to how your business will repay a loan request. Remember, the lender will be looking for documented evidence and assurance that a given loan can and will be paid on time and in full. If you were going to loan money to a friend or acquaintance, wouldn't you want to know if you can get your money back? Well, the lender would want assurances that the debt will be satisfied as agreed. Let's discuss collateral. Lenders find comfort in using collateral to secure a loan. Remember, it's all about lowering the risk. And of course, the question will be asked, what collateral do you have? Or will you acquire with loan proceeds? Collateral could be any examples from real estate, inventory, savings, stock, equipment, and motor vehicles. Lenders can be very creative in using collateral to secure a loan. So prepare yourself. Identify available collateral, estimate its value, and be prepared to provide supporting documentation to justify its worth. Next, we go to personal guarantee. A personal guarantee means that you are willing to pledge your personal assets to protect the lender in a situation where you are unable to repay the loan. As we said earlier, it's all about lowering the risk. Now into the components of a loan package. There are three major components of a loan package. They are statement of purpose, a business plan, and financial statements. Now, a good package will tell a compelling story and answer most, if not all, questions a lender may have about your business and loan request. It will provide enough information and documentation so that your loan request is clearly understood and that your lender could discuss and defend it before a loan committee. And the statement of purpose should include one or several paragraphs describing the amount of capital invested by the owners. We now arrive at the business plan. Having a comprehensive, well thought out business plan is essential to the financial process. You need a business plan before a lender will provide a loan. In fact, without one, even approaching a lender may be pointless. Your business plan should contain at least the following sections: business description and visions, market definition and analysis, description of product and services, and a brief overall view of your organization and management. It is highly recommended that you take the time to educate yourself and to thoughtfully develop such a plan. Let's cover the financial statements. A well-prepared package will include 4 types of statements. 1. Cash flow statement. 2. Income statement. 3. Balance sheet. 4. Personal financial statement. Financial statements are a critical and necessary component of a loan request package. They tell a story about the financial capacity and performance of a business. Let's look at the cash flow statement. A cash flow statement is used to monitor and project incoming and outgoing cash, typically on a monthly basis. Your package should include a current 12-month cash flow statement projected for at least 6 months out. All cash projections should be realistic and supported. Let's look at the income statement. The income statement is a measure of how a business has performed over a specific period of time, usually 6 months or 1 year. Now, if your business is a new venture, your loan package should include a projected income statement projected for 12 months out. And if you are an existing business with a history, include income statements for the last 3 years, if available. Now we come to the balance sheet. The balance sheet is a snapshot business financial capacity at a specific point in time. If you're a new business, your loan package should include a balance sheet representing assets and liabilities as of your planned opening date and another projected for 12 months after your opening date. If you're an existing business, include balance sheet for the last 3 years, if available. Now we come to the personal financial statement. A personal financial statement is a simple balance sheet measuring net worth. It identifies personal assets and debts to help a lender determine a borrower's net worth. This statement is important because it helps the lender evaluate the borrower's financial capacity and ultimately the value of the personal guarantee. How will your loan be evaluated? Your lender will review your loan request using 3 key factors, and they refer to the 3 C's. 1. Character. 2. Capacity. And 3. Collateral. At this point, what you're doing is trying to convince the lender that you and your business are a good risk. When it comes to character, character is actually a check on your financial status and personal credit history, including your previous loan payment records. Also considered is experience in the types of business you are trying to finance, including level of responsibility, education, and business management training. Financial capacity is about having sufficient cash flow to pay off a loan. In the lender's mind, it shows that you are financially aware and that you may be better able to avoid a cash shortage that you would jeopardize making monthly loan payments. This ends the general information program on how to prepare a business loan package.